Rising fuel prices and falling earnings. Let's ask Dan Greenhaus of Solus Alternative Asset Management. He's here with me today at Post 9. It's nice to see you. Welcome back.
Thank you, sir.
That is kind of the question, whether we're about to run into something. Earnings, you're already getting whiffs of disappointments. You had crude oils over 120. I do see that nat gas rolled over really hard today. I mean, that's a 10% swing. But what are you watching? How do the markets feel to you right now?
Yeah, listen, clearly, as I'm sure everyone on the network has been harping on, there's chop. And I think that speaks to the level of uncertainty that market participants are feeling right now. You have the CPI number on Friday, you get the Federal Reserve next week, and shortly thereafter you'll have an updated earnings season. And in the backdrop of all this, of course, is high commodity prices, high oil prices, and basically $5 national gasoline prices. So there's a lot of push and pull right now. I think the bias probably is to the upside in the short term.
Why do you think that?
Well, listen, I think, and a number of us had talked about this for some time over the previous weeks, there were things that suggested the market was due for a bounce for technical reasons. Everybody had gotten so bearish. The internals of the market were sort of set up for something resembling a bounce. And so we could bounce up into the low to mid 4,000s, and that's sort of what we're in the process of doing.
Mid 4,000. So you think we have some more room to go?
Listen, if we got up to 4,400, I wouldn't be surprised. Something like that. That'd be like a 12 or 13% bounce off the lows, perfectly in line with what historical analogous situations might suggest. But even if that happens, you're still left with the backdrop that you sort of articulated and I expounded on: the oil prices, the gasoline prices, the earnings backdrop.
I mean, you just better get the CPI to go your way this Friday if you think you can achieve the levels that you're potentially talking about, right?
And this is actually a really important point. I've seen people on the network constantly talking about inflation coming down. And I just want to be clear to the viewers and to you, my good friend. Inflation at a headline level is going to come down almost no matter what happens, because we're lapping a year ago when the index was going up 0.6, 0.7% per month. Huge numbers that almost surely are going to result in a decline in the headline number. But what you really want to focus on is the month-over-month number. And on Friday, we're going to get a headline month-over-month number that's the consensus expects 0.7, the core 0.5. Annualized out, that's 6, 7, 8% inflation. That's not the type of thing that's going to give the Fed comfort that inflation is moving in their direction, even though the headline number is going to start and is in the process of declining.
What are you expecting from the Fed? And let's just go beyond next week. They're going 50.
Sure.
We know it. In July, they're going 50. They told us, unless there's some, they pull some rabbit out of the hat. And then after that, it was thought, okay, maybe they'll pause. I feel like they've thrown cold water on that, too, in a couple of interviews on this very network within the last couple of weeks. What do you expect?
Yeah, I don't see why they would pause. I know Sarah did the interview with Lael Brainerd, and one or two other people.
Leisman had Mester. I mean, it was the same message from each person.
Yeah, and listen, the idea that they were going to pause was like a momentary floating, and conceptually, I think it makes sense. You want to front load hikes with inflation this high, and then maybe take a minute and see to the extent to which these hikes are having an effect. The problem, as we've said for decades and decades, is monetary policy operates with long and variable lags. Those long and variable lags are not 3 to 6 weeks.
There is this view, though, that inflation has peaked, right? And it's going to incrementally come down.
Sure.
And that's going to take the Fed hikes off the hook. And that narrative is in the ether. I mean, it's out there that the Fed's going to be aggressive in June, aggressive in July, and then magically towards the end of the year, inflation's going to cooperate, so they're going to be able to take their foot off the gas a little bit, and that's going to further stimulate stocks. Do you buy that in any way?
100% I buy the argument. It is a perfectly reasonable and legitimate...
You do buy it?
To the extent it's a legitimate argument. It's not as if we're saying stock prices are going to go higher because Merlin's going to emerge from history and magically levitate them. Like, there is an argument to be made that if the inflation data cooperates, you get, God willing, you get some sort of a ceasefire in Ukraine that allows food supplies to be more widely distributed. So that allows the Fed to sort of take their foot off the brake as the year progresses. Stocks have already incorporated some of the earnings declines, and that allows sort of a second half levitation. I buy that. That's a legitimate argument. The problem with that, though, is once you're done with that, you are left with the ramifications of the most rapid tightening cycle in a lot of respects in our lifetime. I mean, that's a bit of an overstatement, but we'll go with it for now. And there's just, and I've said this to you for months and months and months, and I know people are tired of hearing me say it. It's just really difficult to believe the Fed is going to thread this needle, tighten just so much to bring inflation down just enough. And
well, because history suggests that they're not going to be able to do it.